My name is Ash Perry with the City of Austin Employees Retirement System. I'm here to present the COAERS Mid-Career Seminar today. I also have a couple other team members joining me in the chat. So if you have any questions throughout the presentation, please make sure to place them in the chat and they will assist you with those. With that, we're going to go ahead and begin our presentation. Today's program will include a presentation by COAERS to cover your unique and valuable benefits, followed by a presentation by the Social Security benefits to cover your future benefits with the Social Security Administration, presented by Kim. COAERS is considered a defined benefit 401A plan. The positives when contributing to the COAERS plan is that you will receive an annuity for life upon retirement. The plan is also not affected by the ups and downs of the market, and your contributions are tax deferred, meaning while being an active employee with the City of Austin, your yearly retirement contributions lower your taxable income. When calculating your retirement annuity, your monthly retirement payment is based on a formula. We take your final average salary, which is the highest 36 months of your salary in the past 10 years, times your years and months of service, times a multiplier, which for Group A is 3% and Group B is 2.5%. This provides your monthly annuity payment amount. COAERS also offers survivor benefits that you as a member will get to select during the retirement process to assist in the payout to a survivor listed, along with providing a $10,000 one-time death benefit payable to your listed beneficiaries on file once you retire. COAERS is also here to assist you. We're also here to assist you if you become disabled in the form of a disability retirement if you need to complete a disability retirement for benefits. Now, what is vesting and why is it important? Vesting is an important milestone in your career's path to retirement. You are considered vested when you have at least 5 years of contributing service credit. This point of vesting allows you to retire with COAERS on the basis of your group, which could be Group A or Group B. You can also use proportionate service credit, which is timed with another system such as ERS, TRS, TMRS, and other systems to count towards your 5 years vesting. We will be covering the other proportionate service credit systems in an upcoming slide. If you leave your position with the city and are vested, you will want to keep your funds in the COAERS account to maintain your eligibility to retire at your eligible to retire date. This will also gain you interest on your funds kept with COAERS until you retire from the system. If you leave your position with the city and decide you would like to take a refund and refund your contributions, you can also do so through a lump sum, which is taxed by the IRS at a rate of 20%, or you can do a rollover for your contributions to a qualified retirement plan, such as an IRA or 401k, without penalty. Lastly, if you leave your position with the city and you're not yet vested, you can choose to refund your contributions as well, or keep them in your COAERS account with the expectation you are going to return to the city or a proportionate system at one point in your career. Service credit purchases. You earn service credit for every month you work with the City of Austin in a full-time position, working 30 hours or more a week. In addition to earning service credit, there are several types of services you can purchase. Prior service, where if you previously worked for the city and you left and refunded your contributions, you can purchase back your prior service time. Military service, where if you have military time, you can purchase up to 48 months of the time you served. A DD-214 will be required for this purchase. Non-contributory time, which is time in which no contributions were received by COAERS, such as a part-time, temporary, seasonal, or break-in-service employee. Supplementary time, which is what we consider airtime, meaning once you have reached 5 years making you vested, you can purchase an additional 5 years of supplementary service credit. All of these purchases can be made through multiple methods, such as a transfer from your deferred comp 457 account, through check, or a rollover from a qualifying retirement plan. Purchases are made in 1-month increments and can be made up to 6 times a year. All calculations for purchases can be ran through your Member Direct portal to calculate the cost prior to setting up your payment options with a COAERS specialist. Starting January 1st, COAERS will be implementing changes in response to the new legislative proposal for these. What that means for active employees is a change in contribution rates and service purchase rates and when you can purchase service time with COAERS. The legislative change will also include a contribution increase for active employees from 8 to 9% from your pay each pay period, with allowance for COAERS to implement an increase at the beginning of the year to assist in plan sustainability. Service purchases will also change for active employees for supplementary service, non-contributory service, military time, and sick leave only being purchasable upon retirement. Military service purchases will also be considered full cost with this change. Prior service purchases, which is time in which you worked and refunded your contributions, will remain the same though, and will allow to be purchased at any time with your career as a COAERS member. Proportionate service credit. Looking back at the term proportionate service credit, proportionate time is when you have service with another retirement system. This is interchangeable between systems, but payments are made from each system individually. If you have service credit with another system such as ERS, TRS, TCDRS, along with many others listed on the screen, you can claim this time with COAERS through your member direct account. We will then verify and input that service into our system. To claim proportionate time, you will want to make sure your funds are still located in your proportionate system and have not been refunded. The importance of proportionate time is that even though it will not increase your monthly benefit at retirement with COAERS, it can be used to help reach retirement eligibility. Designating beneficiaries. Working with the city, you can see a few different beneficiary forms you will have to complete throughout your career. You may have filled out one with the City of Austin, but you will also want to make sure you have one on file for COAERS. You can check if you have one on file through your member direct account or by contacting COAERS through phone or email. You have two different types of benefits with COAERS when completing a beneficiary form. The first one is when you are an active member with the city, in which COAERS will pay out a death benefit to those listed on your beneficiary form in the amount of your contributions doubled the amount for any purchase you may have made and all interest accrued on your COAERS account. Keep in mind this does not include the city's contributions of 19%. When you retire, a death benefit for $10,000 will be paid out to those listed on your beneficiary form. You will also have the possibility to list a survivor upon retirement, which is different from the beneficiaries listed on your beneficiary form. Listing a survivor will be discussed upon your retirement with a specialist. If married and listing anyone other than your spouse on your beneficiary form, your spouse will also have to sign the form and you will have to have it notarized. If this is not done, your death benefit will automatically go to your spouse. If you do not submit a beneficiary form, your death benefit with COAERS will be paid out first to your spouse if you have one, then to your estate. So it is important to have a beneficiary on file to remember to avoid extending the payout period for your death benefit. Once a beneficiary form is on file with COAERS, you will want to make sure that it is kept up to date. You can submit a new beneficiary form anytime to COAERS and obtain that form from your member direct account. If you are going to get divorced and you want to make sure that you're updating your form, otherwise COAERS will honor paying out your listed beneficiaries, even if it is an ex-spouse. During the divorce process, you may also be issued a proceeding known as a Qualified Domestic Relation Order, or QDRO. This allows to have a portion of your contributions or retirement annuity paid to your ex-spouse. If you were issued a QDRO, you will need to submit it to COAERS for review and approval. If you are retired with COAERS and listed a survivor, which is someone who is set to continue your annuity payment upon your passing, and that survivor was your spouse, you are now divorced from, you may not change this option. This means that you would not be able to list a new spouse as a survivor if you listed your ex-spouse during the retirement process. A specialist will go over this during your retirement process to ensure that your survivor option and the solidity of that survivor are highly understood. Death benefits. As we recently discussed, as a COAERS member, you receive a death benefit. If you should pass away and you're not eligible for retirement, COAERS will pay out your retirement account balance doubled with interest, plus a matching amount and any amount paid for a service purchase to the listed beneficiary you have on file with us. If you are eligible for retirement and pass away but have not yet applied, Your spouse may retire in your place and start receiving your monthly annuity payments. Once you retire, your beneficiary on file is entitled to a $10,000 death benefit, and any survivor you may have listed upon retirement can begin the continuance payment. The city also pays out a death benefit with any beneficiaries listed with them. This is why it is important to make sure you have a beneficiary on file, both with the city and with COAERS. COAERS wants to make sure you are set up for your retirement with the city. Even though COAERS does not pay or does pay you, so we do pay you a once-a-month annuity payment for the rest of your life, COAERS also does not guarantee that you will receive a cost of living adjustment, otherwise known as a COLA. Because of this, you will want to make sure you have a fallback for any unexpected expenses. Many financial planners will discuss this as a three-legged stool, in which, during your career, you're contributing to other systems to guarantee you are comfortable with your expenses upon retirement. Other systems to look at contributing into are Social Security benefits, a defined pension plan such as your COAERS account, and a supplemental contribution plan, such as a City of Austin's Deferred 457 Empower account, a 401k, or an IRA. It is important to start planning for this ahead of time, so COAERS advises you to reach out to a financial advisor to discuss your options for your contributions to make sure you are prepared for your retirement. Speaking of retirement, when will you be eligible to retire? COAERS offers a multitude of options to explore your retirement. Through Member Direct, you can create purchases, estimate benefits, see your retirement options, submit your proportionate service declaration, and look into sick leave conversion. You may also want to reach out to the City of Austin's 457 Empower Deferred Compensation Plan to see if you've been contributing into that plan. The Social Security Administration will be presenting after the COAERS presentation to answer any questions you may have for them as well. Questions you may want to ask yourself prior to retiring are, do you expect to return to work for the City of Austin as a retiree return to work or to another entity once you retire? Where will you live and what will your housing expenses be? How much medical and dental insurance will your costs be? Do you need life insurance or benefits to pay funeral expenses? Have you updated your beneficiaries for these benefits? How much will your federal taxes be upon retirement? How much will other living expenses be? As we discussed before, you will want to be prepared financially for the retirement decision. By running estimates on your Member Direct account, you will have a better idea of when you will be prepared for retirement and how much you will expect to receive for your retirement annuity. You will also want to start thinking about what you want from your retirement and what you want it to be about. Is retirement just a career transition for you? Do you have specific goals and objectives of your retirement years? What kind of post-career lifestyle do you want? It's never too early to start asking yourself these questions, but you've already taken the first step by attending the COAERS Mid-Career Seminar. Your eligibility to retire varies per your group. Group A retirement requires you to have at least 23 years of service, regardless your age. You are at least 55 with at least 20 years of service, or you are at least age 62 and are either an active contributing member or terminated vested member with at least 5 years of service credit, or a proportionate member with at least 5 years of combined service between COAERS and another system. Group B requires you to be at least age 62 with 30 years of service credit, or age 65 with at least 5 years of service credit. With Group B, you can also choose to retire early with a reduced annuity payment when you are age 55 with at least 10 years of service credit. Your reduction would be based on your age at retirement for every month under the age of 65. Keeping track of your retirement benefits. As I have mentioned, Member Direct multiple times throughout the presentation, I highly recommend registering for it if you have not done so already. COAERS Member Direct portal is a self-service online information portal. You can keep track of your earned benefits by using Member Direct, where you can see and review your accrued earned benefits and service credits, calculate estimates of your retirement benefits and purchases, review beneficiaries, check retirement eligibility, and much more. You can register for Member Direct by going to the COAERS website at www.coaers.org and selecting Member Login/Registration at the top right of the page. Once in Member Direct, it will look like the slide on the screen. There are a multitude of options for both active and retired members in Member Direct. You can also access forms, set up counseling appointments, along with submit documents and apply for retirement through the portal. If you need assistance when creating an account or logging in, you can always reach out to the COAERS team and have a team member walk you through the enrollment process. If you have questions once you're enrolled about where to locate services, you can also reach out to COAERS and we can guide you through where to locate your information, obtaining tax documents, submitting messages, and completing forms. Planning for retirement. You are on the right track for your benefit with COAERS by attending the mid-career seminar. COAERS also offers a pre-retirement seminar once you are within 2 years of your retirement eligibility date. That seminar will go into depth about your retirement and be able to answer more direct questions about the retirement process. You will also want to run benefit estimates to see when your retirement annuity will look like, depending on your retirement dates, listed survivors, and your deductions. When you're ready to retire, you will want to notify COAERS of your retirement by submitting a notice of intent to retire, which should be done within 90 days of your anticipated retirement date. From there, you will have a specialist ready to complete the process with you and to answer any questions you may have specific to your account and your retirement. Your member responsibilities. And as a COAERS member, you do have responsibilities to maintain your retirement account. If there is a life event, such as a marriage, divorce, or the birth of a child, you will want to update your beneficiary form with COAERS. You will also want to keep phone numbers and email addresses updated, which you can do through the Member Direct portal. As an active member, if you are changing your address, you'll want to make sure you reach out to your HR and they will notify us of that. And as a retiree, you will want to reach out to COAERS for address updates, direct deposit updates, withholding updates, and to complete any updates on your Member Direct account. I've placed COAERS contact information up on the slide for you in case you have any additional questions outside of the mid-career seminar. So please feel free to reach out after the seminar for any elaboration on any questions more personalized to what you may have. We're going to go ahead and move you on to our presenter of the Social Security Administration, which is Kim Elder. Kim, I'm going to stop sharing my screen and let you move forward with that.
Thank you. Appreciate it. Hello, guys. How are you? Again, my name is Kim Elder, and I bring you greetings from the Social Security Administration in Dallas, Texas. Today, we want to talk a little bit about Social Security retirement planning and how it could affect you moving forward. What I'd like to do is I'll go ahead and turn off my video so that you can place your attention on the presentation, and then once we get to the question and answer session at the end, I will put the video back on. So thank you for joining. So in regards to Social Security, approximately 182 million workers will pay Social Security taxes in 2023, and approximately 94% of all workers are covered by Social Security. Of course, there is an exception with individuals who are working for the policemen and firemen, as well as teachers. They don't pay Social Security taxes, they pay into Medicare taxes. And so there's a small percentage of folks who do not pay Social Security taxes. Concerning our Social Security programs, there are over 70 million people who actually receive a Social Security benefit each month from the Social Security Administration. Over 63 million receive a Social Security payment, which includes retirement, survivor, as well as dependent benefits, as well as disability as well. Another 5 million individuals receive SSI, which is our needs-based disability program. And then there's a combination of a little over 2.5 million who actually receive a combination of both benefits, depending on the amount of their monthly income. So concerning Social Security as well, as of December 2022, over 48 million people received over $88 billion in benefits from Social Security. And at that same time, over 2.7 million dependents of retired workers received about $2.4 billion in monthly Social Security benefits. So a lot of people are receiving Social Security benefits. So who pays for Social Security? If you are working and paying Social Security taxes, that includes you. And so as a worker, your portion of Social Security taxes includes 7.65%. For individuals who are self-employed, they pay the full amount of 15.3%. Now, to break that 7.65% down just a little bit, so take that 7.65 and divide it to 6.2% for Social Security. This includes the cash payment. This goes towards the cash payment that you receive from Social Security, 6.2% out of every $100 that you earn. And then the rest of that percentage, 1.45%, goes towards your Medicare Part A coverage, Medicare Part A. So in regards to Social Security does support the three-legged stool. Disregard the fact that you actually see 4 boxes here right now. But basically, the three-legged stool means that the more streams of income that you have going into retirement, the better it will be for you. Now, Social Security only covers about or replaces about 40% of a worker's salary. And so that is why it is preferred, or is it recommended that you at least have more than one stream of income during your retirement years. And so your streams of income could include anything from Social Security. It could include your pensions or annuities from your employer, as well as if you have any savings or investments, including 401ks and things like that, IRAs, in any other type of retirement plans, or any other income. That other income could include, maybe you have a hobby that you turned into making cash cow, and now that is additional income that you have come into the household. So again, any and all sources of income that you have going into retirement, the better it will be for you. So as far as Social Security is concerned, how do you qualify for Social Security? Well, you need at least 40 credits. 40 credits is equivalent to 10 years of work, 10 years of work over your entire lifetime. It does not have to be consecutive years. Again, that is 10 years of work over your entire lifetime. A credit this year for 2023 is equivalent to $1,640. And to get your full 4 credits per year for this year, you would have to have earnings of at least $6,560. Now, remember I stated just a second ago that 10 years gets you in the door for Social Security, 10 years of your entire lifetime. But as we're doing our computation, we're actually looking at 35 of your highest grossing years in order to determine what your Social Security benefit will be. Now, there are some situations where we take into account 0 years. So if you're looking at your earnings statement and you have some zeros on there, there could be some situations where we don't count those zeros towards your 35 years. And so one particular situation could be if you did not work because you were at home taking care of your minor children or your minor babies, then of course we can erase up to 5 of those 0 years if you did not work because you were taking care of your children. The other situation with that is, say you were diagnosed with a disability or a medical condition that prevented you from work, we can erase up to another 5 years for what we consider a disability freeze. And so instead of using 35 of your highest grossing years, now we're down to 30 or 25, depending on which situation may affect you. So in regards to Social Security as well, it's important to know what your full retirement age is. And depending on your year of birth, that will determine what your full retirement age is. So if you have individuals born in 1958, your full retirement age is 66 and 8 months. 59, born in 1959, your full retirement age is 66 and 10 months. And for individuals born 1960 or later, your full retirement age is 67. So keep in mind what your full retirement age, but know that you can still apply for a Social Security retirement as early as age 62. If you apply for those benefits at 62 or any time prior to your full retirement age, attaining your full retirement age, then your benefits will be paid to you at least a 20 to 30% reduction of what it would be if you waited to get it at your full retirement age. Also keep in mind as well that if you are working and you choose not to file for your Social Security benefits and you have surpassed your full retirement age, then you are building what we call delayed retirement credits. If you don't start your Social Security benefit until after your full retirement age, then your benefit grows 8% per year for every year that you do not draw your benefits. Now, on our public website, socialsecurity.gov, and if you're going to our site, make sure that you are using the handle .gov. It is not .net or .com, socialsecurity.gov. There are a number of calculators on there that you can use in order to help you decipher what it is that what type of situation that you could possibly be in as you're approaching your retirement years. Use those calculators in order to give you the best guess as to what your benefit will be until you actually file for your benefits as well. So looking at this chart, we like to look at this chart to try to give you a good picture as to how your Social Security grows. Remember earlier I stated that you can file for benefits as early as age 62. But remember, again, if you're born after 1960, your full retirement age is 67. And then anytime that you receive benefits or you choose not to get your benefits after you attain your full retirement age, your benefit does grow at least 8% per year. If you don't choose to get it until age 70, you'll receive 124% of what you'd actually receive at your full retirement age. The biggest part of that is your benefit does not grow after age. Come and get it. There's no reason to let it, to allow it to sit in Social Security's possession if you actually intend on actually drawing your benefit, okay? So for the purposes of this presentation, we're using 67 as the full retirement age. You see the benefits are increased as you go past age 67, but also you see that they are decreased anytime you come in prior to age 67. So in regards to that, make sure you are mindful of what age you are, as well as what your benefit could possibly be. I keep saying full retirement age because that's extremely important. Again, we have a reference to if your year of birth is a certain year, then what your full retirement age is. Keep in mind as well that if you choose to receive or apply for your benefits as early as age 62, not only is it a reduction for you, it is also a reduction for your spouse. If you have a spouse on the record, they could also receive a reduction in the amount of benefits that they're receiving as well. Remember that Social Security, whenever you tell us to hit the enter key and start sending you your monthly benefits, that is when your calculator starts, basically. And so choosing to receive your benefits early not only creates a reduction in the benefits paid to you, again, it creates a reduction in the benefits paid to your spouse. So again, if you're born in 1957, your full retirement age is 66 and 6 months, but you file for benefits at age 62, then that reduction factor for you is 27.5%. The reduction factor for your spouse is 32.5%. So again, you can see the picture there in regards to how drawing your benefits not only affects you, but also affects your spouse. So as far as deemed filing is concerned, if you were born on or before January 2nd, 1954, and you qualify for both retirement and spousal benefits or divorce spousal benefits, you must apply for both of those benefits when you actually file for your benefits. This is called deemed filing, which means that you must apply for and receive any and all benefits that you are eligible for because you were born on or after January 2nd, 1954. The other part of that is you no longer have the option to file and suspend your benefits, which means that if you're filing for your benefits from Social Security, and quite often back in, several years ago, we had individuals who came into the office, filed for their benefits, but chose to suspend theirs while their spouses received their portion of the benefits. Now you no longer have that option. If you choose to suspend your benefits, then your spouse or your dependent's benefits will also be suspended as well. So in regards to benefits for a spouse, your spouse is eligible to receive up to 50% of the worker's unreduced benefits, means 50% at their full retirement age, okay? There is a reduction for early retirement. So if you're coming in any time prior to attainment of your full retirement age, that is paid to you at a reduced rate. And if your spouse is as a spouse, if they're filing on their own record as well as on your record, if the amount payable on their own record is less than what's payable on the spouse's record, they'll pay them the benefit on the spouse's record. Let me try to explain that again. When you file for benefits, we're going to look at how much you'd be eligible for on your own record, as well as how much you'd be eligible for on your spouse's record. If the amount that you're eligible for is more on your own record, more than 50% of what you'd be doing your spouse's record, then we're going to pay you on your own. We will not financially disadvantage you just because you're saying, hey, I want to file on my spouse's record. Remember, based on that deemed filing, you have to file for any and all benefits that you are eligible to receive. So again, if the benefit that's payable on your record is more than what you'd receive on your spouse's record, then we're going to pay you on your own, okay? And so with that being said, if the benefit that you're getting on your own record is less than the 50% on your spouse's record, then we're going to pay you on your spouse's record. There are also benefits set aside for divorced spouses. So if you were previously married and your marriage lasted at least 10 years, and you are currently unmarried now, and you're at least 62 years of age or older, and your ex-spouse is at least 62 years of age or older, you can file for benefits on your divorced spouse's record. Okay, you can file for benefits on their record, as well as vice versa. They can file for benefits on yours. What if you're in a situation where you have more than one divorced spouse? That's okay. Life happens. And so if you have more than one divorced spouse, when you contact us at Social Security, make sure you tell us about the other spouses that you have. As long as you were married at least 10 years, you could possibly qualify to file for benefits on their records as well. So let me clarify that just a little bit more, okay? Say you were married at least 3 times, but you're not currently married now. You're going to the Social Security office. You want to file for benefits on your record. Maybe you hadn't worked as much, and so you know that you could possibly get benefits on your former spouse's record that will pay you a little bit more, okay? Everybody's living, nobody's, deceased or anything like that. So you're coming in, you file for this benefit, you're filing on your divorced spouse record. What if spouse number 3 gives you more money than you get on your own record? Okay, so we will pay you on spouse number 3. Remember, you do up to 50% of your former spouse's record at your full retirement age. Okay, what happens if former spouse number one passes away? That percentage changes from 50% to 100%. Okay, and so in the event of a former spouse's death, you could possibly do 100% on their record based on the fact that you were married to them at least 10 years. Okay, so you could very easily change over from spouse number 3, where you were receiving a certain amount, to spouse number 1 as a divorced spouse. And so you can receive benefits on spouse number 1's record if it's higher for you, okay? And so when you pass away, your surviving spouse may, at their full retirement age, again, receive 100% of your benefit, of the deceased worker's benefit. At age 60, they can file for survivor benefits as early as age 60. Remember, regular retirement is age 62, but for a widow or widower, you can file for benefits on your deceased spouse's record as early as age 60. Now, there is still a reduction factor involved with that, and that reduction factor is about 71.5%. So if you're filing early, then it's paid to you at a reduced rate. If you're waiting until your full retirement age, then of course you'll get 100% of the survivor benefit that you will actually due. So you can file as early as age 60, it's paid to you at a reduced rate, but you are due 100% at your full retirement age. So in regards to, let's do a comparison of spouses where you have a living spouse as well as a deceased spouse. Remember, a living spouse, you can file for benefits on their record as early as age 62. You're eligible for up to 50% of their benefit at your full retirement age. Of course, that reduction factor increases even more if you're applying earlier than that, earlier than your full retirement age, okay? Also keep in mind too, if your spouse is living, you cannot file for benefits on your spouse's record until they file for benefits on their record, okay? That is a stark difference from a divorced spouse, whereby a divorced spouse, it does not matter if your former spouse has filed for their benefits on their record. You can file for benefits on their record even if they haven't, okay? You can file for benefits on your divorced spouse's record even if they have not. If you are currently married, you have to wait until your current spouse actually files for their benefit before you can file on their benefit. So make sure that you know the difference between the two. If you are a surviving spouse, meaning that your former spouse is deceased, then again, your benefits can start as early as age 60. Or if you are disabled, you can file for what we call disabled widow or disabled widower's benefits as early as age 50. Disabled benefits for a surviving spouse can start as early as age 50. Again, if your benefits are starting at age 60, their reduction factor is about 71.5%. But also remember that you are due 100% if you choose not to file until your full retirement age or later. So in regards to survivor eligibility factors as well, if you have minor children, minor babies, your minor children can receive benefits on your Social Security record. We will pay them up until they attain age 18 or until they graduate from high school. If they have not graduated from high school and they have attained age 18, then we can pay them up until they're at least 19 and 2 months old. Social Security does not pay college children. So again, once they have graduated high school or attained age 18 or 19 and 2 months, then those benefits will stop. Those child's benefits will stop. If you have a disabled child where the disability decision was rendered to them prior to them attaining age 22, then your disabled child can receive benefits on your record as long as they meet the disability requirements as stated by Social Security. So disabled child disability decision must be decided for that child prior to attainment of age 22. Again, widow, widower, divorced widower, you can get benefits as early as age 60. If you're disabled, as early as age 50. Remarriage after age 60 will not affect benefits. What I mean by that is this. If you're receiving widow's benefits and say you meet a new special someone and you're at least 62, 63 or whatever, and you decide to get married, if the benefit that you are receiving on your deceased spouse's record is more than what you get on your current spouse's record, then you can continue to receive the benefits on your deceased spouse's record. Okay, you do not have to stop receiving those benefits just because you've gotten remarried. Again, especially if that will financially disadvantage you, then of course we want to make sure we give you the maximum amount that we could possibly pay you. So remarriage after age 60 will not affect your benefits. Again, you can take survivor benefits as early as age 60, then switch to your retirement on your own record as early as age 62 or even later. Or you can take retirement benefits as early as age 62 and then switch to survivor benefits at a later date if that benefit is higher. So remember that when you're coming into Social Security, we're going to ask you all types of questions, all types of nosy fact-finding questions, and that is for a reason. We want to make sure that we're paying you the maximum amount that we could possibly pay you. Other survivor benefits as well. Remember, there is a one-time lump sum death payment of $255 that is paid to a surviving spouse or children who meet certain requirements in the event of a worker's death. Again, that is a one-time payment, $255. Parents' benefits are for a parent age 62 or older who is receiving at least 1/2 support from their children. Now, to be honest with you, these are rare, but they do occur, and it is an option. So if you are taking care of your parent, or if you are a parent being taken care of by your children, then you could possibly receive parents' benefits on your children's record based on the fact that they are providing care for you and taking care of you, 1/2 support for you. Now, in this day and time, we have a lot of grandparents who are taking care of their grandchildren. And so if this is your situation and you are taking care of your grandchildren could possibly be eligible for benefits off of your Social Security record. Now, and that is if they are not receiving benefits from their own parents, from their mother or father, then you could possibly be, add them to your record so that they can receive benefits off of yours. Now, in most situations, the grandparents will have to legally adopt the grandchildren. And it happens quite often that they do that. And so if you are a grandparent taking care of your grandchildren, make sure that you advise us of that when you contact us at Social Security to file for your retirement benefits so that we can add those grandchildren to your Social Security record. Now, what happens if you're working and if you're retired and you decide that being at home 24 hours a day, 7 days a week was not the life that you envisioned? You do have an opportunity to go back to work. If you are under your full retirement age, you must limit the amount of earnings that you're actually earning on your job. So again, under your full retirement age, you can go back to work, but you must limit the amount of your earnings. The earnings limit this year in 2023 is $21,240 gross pay for the year. Okay. If you go over this amount, then so you'll be overpaid $1 for every $2 that you go over it. Okay, so in regards to that, just keep in mind, you know, if you go back to work, that is perfectly fine. Make sure that you limit the amount of your earnings to $21,240 gross pay per year. The year that you actually reach your full retirement age, that middle part of the chart here, you can see a drastic increase in the amount of earnings that are here on this chart. And the reason that you reach your full retirement age, you can actually earn more money. So, and that amount is $56,520 for the year prior to you reaching your full retirement age. Let me give you an example of how you can put this into play. Say, for example, my birthday is in August, and say I come into Social Security in January of the year that I actually reach my full retirement age. So if I choose to go ahead and file for my benefits in January, knowing that my birthday is not until August, I can earn $56,520 between January and July. As long as I don't go over that amount, I am good, right? The month that I make my full retirement age in August, right? In August, nothing matters after that because I've reached my full retirement age and Social Security has no limit. They will not reduce the amount of my Social Security check based on the fact that I have reached my full retirement age. And so I can get my full and maximum benefit. So me coming in August, 7 months early, on the year that I reach my full retirement age, I have an opportunity to have earnings from my job, have at least a couple of $1,000s a month from Social Security, and I'm good. After August gets here, then it doesn't matter. I can be a millionaire. It doesn't matter what my earnings are. Social Security will not reduce the amount of my Social Security check based on the fact that I have earnings. Now, for example, this is a really modest example here. So say if your Social Security check is $700 a month and you go to work and you have earnings of $21,240 or less, then 700 times 12 is $8,400, and your benefit is not reduced based on the fact that you're working, right? But say your benefit is $700 and you earn $22,000 or $23,000, you can see the income or the amount of Social Security that is payable to you is lowered based on the fact that you've earned over the allowable limit. So make sure that you, if you're coming in and you're filing for Social Security early, you're filing prior to attainment of your full retirement age, that if your earnings are more than the allowable limit, then the amount payable to you from Social Security is going to be less. We're going to hold a portion of your check in order to make sure that we're giving you the right amount of money. So in regards to Social Security, we are looking at the income that counts as earnings, of course, includes your gross pay from employment as well as your net earnings from self-employment. We do not look at, or we do not count inheritance payments, pensions, investments, dividends, capital gains, or any other sources of income. Again, all we are counting is your earnings from employment or self-employment. Now, remember, just a couple of slides ago, I stated that with your earnings and with your Social Security, that once you reach a certain point, that we as Social Security do not care how much you earn as far as, you know, what your income is concerned. Well, there is always an agency that does care, and that is IRS. IRS always cares what we earn, right? And so if you are a single person and you are receiving Social Security plus you are working, if your earnings are between $25,000 and $34,000 a year, you may have to pay taxes on your Social Security benefit, and that tax amount could equal up to about 50% of your benefits. If it's more than $34,000, then about 85% of your benefits may be taxable. If you are married and filing a joint return, a joint tax return, and you have a combination of income coming into the household between you and your spouse, if your earnings for that time period is $32,000 to $44,000, then approximately 50% of your Social Security benefits could be taxable. More than $44,000 gross pay per year, then approximately 85% of your benefits may be taxable. If you are married and filing a separate tax return from your spouse, just know that you will probably pay taxes on your benefits as well. So let's kind of talk about the windfall elimination provision. We call this WEP. So with the WEP provision, WEP can apply if you've reached age 62. After age 65, you became disabled after age 85. You reached age 62 after 85, you became disabled after 85, and you're first eligible for your pension after 1985. So 1985 was a big year for windfall elimination provision. And what it states is if you work for an employer where you did not pay Social Security taxes, you could be subjected to a WEP reduction, a windfall elimination provision reduction of the amount of Social Security that is due to you. Again, remember, the folks who don't normally pay Social Security taxes are your teachers, so they pay into teacher retirement. You have the policemen and firemen, they pay into their own retirement system. And it could be some other agencies or companies who actually do this. And so those individuals, they pay Medicare taxes, they don't pay Social Security taxes. But so, they could be subjected to a windfall reduction of their benefits. So based on this chart here, the chart on the left shows what everybody in the United States is how their computation is done as far as their Social Security is concerned. For individuals who are not paying Social Security taxes, they are looking at the chart on the right, okay? And so the best part of the WEP reduction, and no one wants to hear that their benefit could be possibly reduced, but the best part of the WEP reduction is the average reduction is about $280 a month. The maximum reduction this year in 2023 is about $558. So keep in mind that if you have an individual who worked and didn't pay Social Security taxes, worked for an agency, eligible for a pension of some kind, and they're getting their pension, but they also maybe worked on the side, did some other work, maybe worked at another job prior to getting that pension or even after they retired from that job, and whereby they're eligible also for Social Security. Let's say their Social Security check is $1,500 per month. They're under the maximum reduction for WEP. We would hold 500. We send them the other 1,000. So it's not for anything. They will still receive a benefit from our program. It's just that benefit will be paid to them at a reduced rate. Now there is a means for us to be able to not reduce your benefit if you work for an employer where you didn't pay Social Security taxes, as long as you have at least 30 years or more paid in, whereby you pay Social Security taxes while you work for that particular job where you did not pay Social Security taxes. You can see based on this chart here that the first one says 30 or more. You see that 90? That 90 corresponds with what's on the last chart where it says you're going to use the regular formula in order for us to determine what your Social Security benefit will be. If you have 20 years or fewer, then that's where you see the 40 at the bottom that says, yes, you're going to be in full WEP reduction to the point where we're going to deduct whatever we need to in order to pay you and pay you the rest of your Social Security benefits. If your years of paying Social Security taxes fluctuates between the 20 and the 30 years, you see the reductions there. It goes 90, 85, 80, 75, 70. And so it depends on the number of years where you did pay Social Security taxes at the same time where you were working for the employee where you did not pay Social Security taxes. So if you fall in this category, we do have a WEP calculator on our socialsecurity.gov website. You can use that in order to determine possibly what your reduction factor would be as far as Social Security is concerned. So remember, windfall elimination provision has to do with you, the worker. You're the worker working for an employer where you did not pay Social Security taxes, as well as maybe working prior to that or even after that where you did pay some Social Security taxes. That is for you, the worker. Government pension offset strictly relates to you filing for benefit on your spouse's record. So if you're filing on a spouse's record as a regular spouse or a widow or widower, then government pension offset applies to you. Government pension offset means that you work for an employer where you didn't pay Social Security taxes, even not at all, right? But now you're eligible you're receiving your pension and you want to see how much you'd be due on your spouse's record, okay? So the calculation for the GPO, the government pension offset, is a little bit simpler. Basically, we take 2/3 of your non-covered pension in order to determine how much we could actually pay you from Social Security. So for example here, if you're receiving $1,200 in a non-covered pension, 2/3 of that $1,200 is $800, right? Say your benefit on your spouse's record as a spouse or a widow or widower is $750. So because the amount of your 2/3 reduction is more than the $750 that we can pay you from Social Security, then there's no benefit payable right now. Remember, in life, the amount payable to you as a spouse is 50%. In death, that changes to 100%. So say you apply for benefits as a widow or widower because your spouse is now deceased, that benefit that would have been paid to you is $1,500, right? But that 2/3 reduction from your non-covered pension is $800. $1,500, $800, the amount payable to you from Social Security is now $700 as opposed to zero when your spouse was alive. So if this situation is your situation and you file for benefits at Social Security and your former spouse is still living, or your current spouse is still living, then make sure that if something happens to them and they are no longer in the land of the living, then make sure that you recontact us here at Social Security, because that benefit does change and you could possibly be due a benefit then in the event of their death. Okay. So again, to do a comparison of the two programs, with the WEP program, it applies if you have 40 credits of plus a non-covered pension. So you have your 10 years work where you paid in Social Security taxes, but you have a non-covered pension. Remember, WEP does not apply to you if you have 30 years or more, right? 30 years or more does not apply to you. You'll get your maximum Social Security plus your maximum pension from your non-covered pension. You'll be fine, right? With GPO, again, you're applying as a spouse. You're applying on a spouse's record or as a widow or widower. And then that reduction factor goes from there. We're looking at 2/3 of your non-covered pension in order to determine how much you be actually due from Social Security. Now, as far as our online services options are concerned, if you have not gone to socialsecurity.gov website, this is what our website looks like right now. We've gone through some revamping of the website, so now it should be a little bit more user-friendly for you. And so this is what our website looks like now. It still has all of that pertinent information that it had before the revamping. One of the things that's extremely important is if you do not already have one set up, please, at the end of this presentation, go to socialsecurity.gov, set up a My Social Security account. The My Social Security account is extremely important because it allows you to just kind of maneuver through the programs, look at your earning statement, look at your previous earnings that have been ported to Social Security, and see how this benefit affects you, right? And so if you're currently receiving Social Security benefits, or you're entitled to Medicare, you can use your My Social Security account in order to request replacement Social Security cards, replacement Medicare cards. You can get a benefit verification statement. You can update your addresses, phone numbers, direct deposit, all that great information. You can use your My Social Security account in order to do that. If you are not receiving My Social Security benefits, you can use that again for replacement Social Security cards. You can use it to apply for your Social Security retirement or Medicare benefits. If you need a benefit statement that even says that you are not receiving Social Security, you can use that as well. Now, one of the things I want to bring to your attention as well is we are no longer mailing out your Social Security statement unless you are over the age of 16, have never filed for Social Security before, okay? So if you are looking for your Social Security statement, and the Social Security statement used to come to you 3 months prior to your birthday on the 5s and 10s, say 30, 35, 40, 45, or whatever, moving on, that statement used to come to you with green font. I always say green like money, just so you can make that distinction of that. If you have not received that statement in the mail, but you receive one that looks like this, do not throw it away, because this is your Social Security statement. This is what it looks like now, right? So if you have this statement in the mail, this is a legit statement for you. It still has all that great information that the prior statement had on you. What I like about it, you see this little blue chart here that says it's 62 and goes through age 70. That kind of looks like that chart in point that we showed earlier, right? And it shows you what your benefit could possibly be if you started at age 62, if you started 63, 64, and moving on, right? Remember I stated before that your benefit does not grow past age 70. There's no reason for you to let it sit. So come and get your money if you're at least age 70 and have not received your benefits, okay? This statement also tells you information regarding disability benefits. Remember, disability pays you the maximum amount no matter when you apply. And so if you look at your earnings statement and look at the amount that is posted next to your full retirement age, those amounts should be comparable, okay? They should be comparable with each other. It should be just about the same amount. Again, disability pays you 100% no matter when you file. 100% meaning the amount that you're eligible for at your full retirement age. This chart also gives you information in regards to survivor benefits in the event of your death. Your spouse or your minor children could be possibly eligible for a benefit on your record. The chart to the table to the right there kind of gives you the information and overview of what your earnings are, what is reported to internal revenue in regards to your taxes. And so make sure that you review this information. Always check your numbers, guys, because it's extremely important to make sure that the information that we have is what's true and correct based on your records as well. Okay, check your numbers, because we want to make sure that, say you work for an employee and you earn $63,000, but the employer transposed the numbers and put $36,000. That is a huge discrepancy. Okay, so make sure that you're checking your numbers every year to make sure that the information that we have is correct. Remember, this information comes from your tax information. No one files their taxes with Social Security, so basically the information is coming from your tax documents is the information that is sent to us here at Social Security. Make sure you're checking your numbers. Make sure you're checking for your 0 years. If you have some zeros in there, make sure those zeros are legit. Okay, so again, this is your earnings statement. This is what it looks like with the red, white, and blue, kind of like with our logo. And so do not trash this if you receive this statement in the mail. If you're between the ages of 49 and 60, you'll have access to an additional fact sheet that kind of gives you some information that kind of tells you how to get ready for your Social Security. So it just kind of gives you an overview of some different things and just give you some different tidbits in regards to Social Security as well. If you're applying for benefits, remember that the best way to apply for benefits is to do it online. Again, online via your My Social Security account, or by telephone if you need to contact our field office or our national 1-800 number. That number is 1-800-772-1213. Or if you need to do it at the office, you can go into our field offices in order to do that. Now, I will caution you with this. If you're planning to file for Social Security retirement and you just say, hey, I'm going to go to the Social Security office and I'm going to file for retirement today, the field office may not be able to take your claim today, but you still may have to schedule an appointment for you. So the best thing is call us, let us schedule an appointment for you, so that you don't have to take a blank trip to the office to the point where someone may not be able to actually help you on that particular day when you go in. So again, the best way is to file it online. Call our 800 number, schedule an appointment, or even if you go into the office, the field office may have to schedule you an appointment as well. You do have the option to file your application in person in the office, or they can do it over the phone with you. You'll get the same type of service, basically, but it is your option. It is available to you at your convenience. So whichever one that you actually choose, that is the one that you can do as well. You can follow us on our social media, on all social media platforms, including Facebook, X, formerly known as Twitter, Instagram, LinkedIn, as well as YouTube. This is my contact information here. My email is kimberly.elder@ssa.gov. My phone number rings directly on my desk, 214-767-4228.
I want to thank you too, Kim. You did amazing presenting to that. Thank you so much, everybody, for all the questions you asked today.
Okay.
They were great questions going over everything. If you have any additional questions, don't hesitate to reach out. And if you didn't grab Kim's information, I know it's up there right now, but you can always reach out to COAERS. We'll have that information for you as well. COAERS really appreciate you making the mid-career seminar with us, and we hope you have a wonderful day.
Have a good one, guys.